Hello, hello, everyone. Welcome back to another edition of the Week in Charts. I'm your host, Charlie Bilello. With me today, special guest John Hagensen. John is a partner managing director at Creative Planning. He also hosts the awesome Rethink Your Money podcast. John, welcome to the Week in Charts. Welcome back, I should say, to the Week in Charts. We had you a few months ago. Great to have you back again.
Yeah, happy to be here.
Awesome. So if you're watching this on YouTube, hit that subscribe button for more content just like it. A lot of exciting content in the next few weeks as we enter 2025. It's coming, and we got a lot more coming to the YouTube channel, so make sure you're subscribed for that. Here's what's on the docket today. John, I hope you're prepared for a multitude of topics here. Inflation is warming. We got the CPI report and showed a little bit of warming. We're going to dig through the data there. I want to get your take. Number two, easing into a mania. So Fed expected to cut again next week. Is that a good idea? We'll debate that. Is free money the cure for high prices? We're seeing another example in my state here in New York where they seem to be suggesting that is the cure. Number four, Nasdaq 20,000. A lot of record highs this year. This is a big one. Nasdaq doubling in the last 4.5 years. Number five, Apple hit its highest multiple ever this week. Number six, America's exceptional valuation. I'm going to talk about the spread between U.S. equity valuations and international valuations. And we'll end, as we always do, John, something positive. That's rising real wages and the spike in small business optimism that we've seen. Two good things going on. Okay, let's start out here. Number one, inflation is warming. We got the CPI report. We expected it to be higher. I was talking about this for a few weeks, and that's what it actually showed. We got overall CPI moving up to 2.75%, highest level in a few months. And that core CPI, very sticky here at 3.3%. So yet another reading for that core CPI above 3%, 43rd consecutive month, longest period of elevated inflation we've seen since the early 1990s. And you can see on this chart here, we had been moving steadily lower from that peak in inflation in June 2022 at 9.1%. We got all the way down to 2.4%. That's when the Fed decided to cut interest rates 50 basis points, and now we're starting to move back in the other direction. I'm showing you here all the different components, major components in CPI. Anything standing out to here, John, when you talk to clients, what are people complaining about most these days when it comes to inflation?
Well, just the cumulative effect. I think so often we look at that month to month or even annually. The much bigger impact is what has inflation been over a longer period of time? And that's what's impacting folks, obviously, at the grocery store and when they're making purchases a lot more than what it's doing this month, although that tends to be the headlines more than anything else.
Sure, 100%. And on that point, what I'm showing you here is that cumulative inflation since January 2020. Yes, it's good that inflation is down to 2.7% over the past year, but we've been running at above 4% annualized since the start of 2020, and we're well above the Fed's 2% target, as we'll talk about in the second segment if we look at the annualized rate since January 2020. But how about things like auto insurance? Because this is become a crazy one, and I don't know about you, but every few months, I'm getting the new policy statement, and I'm looking at it, this can't be right. And then I call up Geico, and they're like, yeah, it's right. And they're like, you could shop this around, but you're not going to get a better rate. Just incredibly frustrating. I'm showing here a 95% increase in auto insurance on average over the last 10 years. If we look at overall CPI, it's increased 33.5%. What do you make of auto insurance? Obviously, hopefully this is not sustainable. But why are we seeing such a spike, and what can the average person do about it?
Well, for starters, Charlie, you need to stop getting 4 tickets every month. That's probably part of your problem. You're lucky Geico even wants to keep insuring you.
I left that part out, yes.
Yeah, exactly. I can't figure out why they're increasing my rates. No, I mean, honestly, cars are going faster than ever before. And yes, they're safer, but we are on our phones and distracted drivers more than anything else. My wife got a Tesla, and it literally beeps at you when the light turns green to let you know, like, get off your phone. The light's green, you can start driving so that the person behind you doesn't have to honk. But in all seriousness, we are very distracted as a society due to cell phones, and I think that's increased rates alone just with that.
Yeah, not to mention we have this huge, of course, asset inflation, which includes the cost of cars. So obviously, cost more to replace.
Hmm.
But if you look at it, insurance company stocks, they're definitely benefiting from this as well. There's no question there. So
They are.
what we need is more competition, more people to jump into this market, and that usually solves things on its own. Hopefully, a year from now, we're not still talking about auto insurance, but I'm not sure about that. But what can you do overall as an investor in terms of inflation? Well, you have to invest because the one thing's for sure, John, a
Bingo.
year from now, prices are likely to be higher. The purchasing power of your dollar is going down. Over the last 30 years, it's been more than cut in half. And over that period of time, the S&P 500, after adjusting for inflation, is actually up 972%, about 8% per year after inflation. So if you guys are watching this, if you're looking for a second opinion on your portfolio or your plan going into 2025, reach out to us today. creativeplanning.com/Charlie. You get a free wealth path analysis. And John, I know you know a lot about that wealth path analysis. What can people expect with that? John's one of the advisors who created this concept, and he's one of the ones potentially you could speak to if you fill out that form, creativeplanning.com/Charlie.
Yeah, really just a portfolio MRI. And because we are a family office for all, as Barron's has called us, 60 attorneys, 265 CPAs, we're not just looking at the portfolio. I mean, we can certainly do that. But I think the broader question is, how does this fit into my bigger overall tax strategy? What does this mean for my estate planning? And really looking at this more holistically and comprehensively, because we are a large law firm and a large tax practice doing over 30,000 tax returns every year, in addition to the 500 certified financial planners like myself, we're able to look at this and answer hopefully whatever questions you have that start with a dollar sign in front of them, to make sure, because you and I both know your investments are really just a tool to accomplish whatever it is you're trying to do with your money. And there are implications and overlap when it comes to other aspects of your financial life, like your taxes. And so looking at those in a vacuum, you might be missing something. And we'll be able to go through all of that. Best part, independent. You're meeting with a credentialed fiduciary. We've done this for thousands of people. You're sold nothing. There's no upfront cost. There's no back end cost. There's no commissions. It's just, let us give you our perspective after having done this for 40 years as a firm, managing or advising on $330 billion. And you do with that information whatever you want. There's no pressure on our end. If you need our help, great. If you don't, but we just want you to walk out of there feeling like you have a better perspective and handle on what you've worked a lifetime to save.
Awesome. So John's in Arizona, I'm in New York, but we have advisors and clients in all 50 states. So reach out today, creativeplanning.com/Charlie. Creative Planning, we have over 325 billion in assets under management and advisement, and we're here to help. So reach out today for that free wealth path analysis. Okay, number 2, easing into a mania. Let me give you the setup here, John. Tell me if this makes sense.
I saw this. This is good.
Stocks all-time highs, home prices all-time highs, Bitcoin all-time highs, national debt all-time highs. We just talked about core inflation, longest streak above 3% since the early 1990s. And the Fed is meeting again next week, and they're expected to cut interest rates. And speaking of mania, we have something now called fart coin. I can't believe I'm actually saying this, but there's a meme coin named fart coin, and this week it hit an all-time high, and its total market cap is actually north of $500 million, which is kind of crazy. So I went on X's AI, Grok, and I created this image here of Jerome Powell flying a helicopter and letting go bills. I don't know if you remember the nickname Helicopter Ben, but are we going to see here Helicopter Jerome?
We just might. It was funny, right? What would have made sense is if you listed all of those things and then the last thing said Fed expected to raise rates.
Yes.
Right?
Yeah.
But that's not what it said. And I think, you've been on this for a while, Charlie, saying, why are we already cutting rates? Like, why are we, with all of these other factors? What's your take, Charlie, on why, we're still cutting rates in the midst of this?
I think the Fed just has a bias towards easing, and their belief is ease whenever you can, ease whenever possible. And I think they're looking at the national debt. They're looking at that fiscal situation. They're getting pressure saying that interest rate's too high. We need to cut interest rates. And they haven't learned, I think, a thing from that excessively easy monetary policy era. They certainly didn't learn anything from 2020 or 2021. They never acknowledged that they kept rates too low for too long. They never acknowledged that it was a mistake to buy mortgage bonds and drive interest rates on mortgages below 3%, creating a housing bubble and freezing the housing market for a generation of home buyers. So I think just very simple, John, they're saying, look, The Fed funds rate is above 4%. Inflation over the last year is 2.7%. And we're going to forget about all of that cumulative inflation and just look at those two numbers and say, well, we have room to ease because the Fed funds rate is above the inflation rate. To me, that doesn't make sense. But you and I are not in charge of the Fed. They are. And if we look at what the market is saying here, 98% probability of a Fed cut next week.
Well, it's interesting. You just mentioned it with what you said about the Fed. I mean, yeah, so you think that maybe the national debt and the interest on that debt is the higher priority at this point than the chart that you showed earlier that shows inflation coming back up a little bit. You think that's less of a concern than getting the national debt and the interest rate under control?
I think they might make that argument. I also think they just have a different fundamental belief in terms of what the Fed's role is. And they had this notion that was created under Ben Bernanke that was called the wealth effect, and that by keeping money excessively cheap and easy, you would lift asset prices, and that would lead to higher consumer spending, and that would be a virtuous circle, so to speak, where that would lead to higher economic growth, never mentioning the downsides of that type of policy.
Sure.
So to be clear, though, John, I'm not suggesting that short-term interest rates shouldn't be lower. Maybe they should be. I'm just suggesting if your goal is 2% inflation, and we haven't even gotten to 2% yet, and the economy is still growing and the unemployment rate is still low, why not try to achieve that goal before you go and start easing, especially with credit conditions where they are, stock market where it is, what these other asset classes are doing in terms of speculation. It feels to me very much like the 90s, where the Fed is kind of goosing this market higher and it doesn't need this additional stimulus. It doesn't seem to me that monetary policy is restrictive here with the credit markets and equity markets doing what they're doing.
And they also may have spoken too soon. They let the cat out of the bag a bit with the expectation of them cutting rates. And I think it's sometimes challenging for the Fed to go back after the fact when they know sentiment is in one spot and say, nope, we're not going to do that. Obviously, they have over the last year. But I think that's part of it too. When they put an expectation out there, they don't want to go back on that.
They don't like to surprise the market.
Yep.
Right? There was back in the day when Volcker was in charge, he would come in. No one knew what he would do.
The briefcase, like how thick is it? Yeah, right.
No one knew. It was a surprise. Now it's completely telegraphed, as you can see here. There's no chance that the Fed is not going to cut interest rates next week. But after that, John, and here's the point, I think they cannot ignore all the other stuff we've been talking about for much longer. And I think in January, if you look at the expectations, it's that the Fed is going to hold. And in 2025, at least right now, the market's saying maybe only 2 rate cuts. So we're not going right back to that 0% policy that we had following the financial crisis for 7 straight years. That seems very unlikely given this backdrop that inflation's not going away. It's still here. It's still a problem. We can't just go back to easy money if we want to maintain credibility as an inflation fighter. That the Fed
I had a question for you, Charlie. How do you think this relates to that first time home buyer that's been frozen out of the market? Obviously, mortgage rates don't parallel exactly with the Fed funds rate, but what do you think this looks like for them over the next year or two? That person that's on the sideline who's watching this, who's like, man, I'm really hoping rates can come down so that I can, have a reasonable mortgage and get into a house. Like, how do you see this relating to that?
Well, what the interesting thing is, John, so far, that when the Fed started cutting rates in September, the 10-year yield was well below 4%, and now it's well above it. And what mortgages price off of are 10-year and 30-year Treasury yields. And so if long-term inflation expectations remain high, then you're going to have mortgage rates not coming down that much, even though the Fed is cutting interest rates. So
counterintuitively, it might actually benefit mortgage people looking to get into the housing market to see them increase rates, which would be very counterintuitive to what most people would think.
Yeah, ultimately, the bigger factor, John, yes, the mortgage rate matters a lot, but the bigger factor has been just that prices went up so much over the past few years and really deviated from incomes. And the fact that
goes back to the cumulative effect, right?
Yeah, we have so little supply. So we have to, and the market has to be allowed to do this and figure out a way to, with all of the zoning issues and everything else, like as a country, we have to make it a national priority to kind of incentivize more building. So we have so much household formation over the last 20 years. Building has not kept up with that, and that's a real problem. The good news, though, is if you're waiting to buy, renting is getting cheaper, actually. Like apartments, there's a big supply there, and we've had a huge construction boom in terms of multifamily housing. So what I've been talking about every week on the show is that rents are actually flat over the past few years, and on a real basis, they've actually come down because people's incomes are still going up. So that's the good news. You're actually being paid to wait because housing, to buy a house, the cost relative to renting one, the spread has never been higher than it is today. So I don't see a lot of downside. But
I think the counter argument, though, Charlie, I think the counter argument that a lot of people on the sidelines are worried about is we saw this, we saw what we saw in 2022. And I think most people thought, well, if that's what happens with rates, look at where mortgage rates went. Housing prices will finally get a correction. When that correction didn't occur in the midst of massive spiking mortgage rates, I think that person's on the sidelines very worried about when mortgage rates are finally under control due to the supply-demand imbalance, where are housing prices going to be? I think people are like, I got to get something sooner rather than later because I don't want this to run away from me even more on the pricing side.
I agree. It's such a complicated animal, and you have competing interests here because most people, the people that own a home, they don't want the price to become more affordable, right? Everyone wants their house price to go up, which is not always rational because if you're intending on living in the house for 20 years, well, guess what? Your insurance costs have gone up, your taxes have gone up because of this big price increase, and no one's writing you a check, right? Because your house price has gone up. Yes, you could borrow,
unless you're taking a HELOC, right? Which a lot of people do.
You could borrow from it. I'm not saying it's not good. I'm just saying that there's competing interests here. But for the younger generation, like clearly this is delaying household formation, putting off things that other generations had access to because housing is simply not affordable based on people's incomes. That's not a good thing for a country. Housing, people get this wrong, John, where they think they equate housing with stocks. It's not the same thing. It's not a productive good. It's not like a company that's producing value and that could be exported and that's leading to increases in productivity and other gains. It's just a place to live. Now, that's important, but you don't want that to be unaffordable. You don't want people be stretching and putting all of their money into that housing payment. Now they have nothing left to save and invest in things that are more productive. But we could do a whole show about this. Maybe we will at some point.
Sorry, I took you off track there.
No, it was not off. It's an absolutely essential conversation. There's no simple fix to it, but we need to get the Fed and the government out of the housing market. That more than anything else has caused this huge spike in prices relative to income. So why do I think the Fed's going to pause? Because we're going to see CPI continue to go up here. The Cleveland Fed is expecting 2.86% for the December number. That'll come out in January. And core PCE, John, that's the Fed's preferred measure. They're talking about 3% here potentially for that December number. Obviously, that's a percent away from 2%. So I don't see how the Fed, if these data points come in like this, I don't see how they can continue cutting rates in January. And Trueflation puts out this real-time inflation report. I don't know if you follow this.
I like this, yeah.
It just moved back above 3% for the first time in a while. This is the highest level in the year. So the Fed should be paying attention to things like this and not just be looking at lagging data points. A lot of the CPI data points are lagging indicators. They should be factoring stuff like this into their analysis as well. And the overall point is, John, we don't want to repeat the mistakes of the 1970s where the Fed was too quick to say the war on inflation is over, and so now we can go back to cutting interest rates, and then we have to do an about face. It's going to likely turn out to be a trickier thing to just get inflation back to 2% and keep it there. So if the economy's doing well and the stock market, everything's doing well, let's err on the side of staying tight. But the Fed does what they'll do. They definitely don't take my call when I try to contact them. Okay, let's move on to number 3 here. Is free money the cure for high prices? And as we talked about, it's the cumulative prices that people really don't like. And I'm showing you some of them over the last 4 years. And you could just see shelter, you could see new cars, used cars, everything's up a lot. And this is what people are feeling. And in response to this, it's kind of interesting. You have a few states, California tried this a few times, and now New York, my state, is proposing what they're calling an inflation refund check. They're talking about checks from $300 to $500 to send out to give them relief from these higher prices. Does this make sense to you? Is this something, do you think, that will solve the inflationary pressures that we've seen?
I mean, of course, it doesn't make sense. This is as good as the Inflation Reduction Act when we dropped trillions of dollars, helicoptered as you showed earlier. So yeah, I mean, you're not going in the short term. Sure, like in the short term, somebody will say, "Well, this is great. I can
Yeah.
help pay for things," but you're obviously exasperating a much bigger problem, and you're increasing the issues. I mean, it's kind of shocking actually to me that someone that's reached this level of height, and I don't know a lot about like New York governance, but that's wild to me that somebody would actually think this is really smart in the middle of an inflationary environment with given the price increases that you just showed. What do you think, Charlie?
I think put simply here, their solution to the problem was the cause of the problem
Good
itself,
point.
right? So we
Yeah.
borrowed $5 trillion in 2020 and we sent it out to people, and these were wildly popular bills, by the way. And
Oh yeah.
this probably as well. If you polled New Yorkers, they probably say, "Yeah, sign me up." Who's going to say no to free money? And
Right.
that's fine. Maybe they'll end up doing it. They probably will just because it's a popular. But they should understand that that's not going to lower prices. If you put more money into the system, that's going to cause prices to rise higher unless you offset it. So what they're not
Mhm.
suggesting here, and we didn't do in 2020 and 2021, we didn't tax people
Right.
more to pay for it. We simply borrowed it. So you're creating new money essentially. So it seems like there's no cost. That's why they call this free
Well,
money.
Charlie, you know what this
And
reminds me of? This
yeah,
reminds me of, with my kids. I know you got a bunch of kids. I got 7 kids. And then, so I remember a couple years ago, one of them said, "Dad, like basically we were talking about poverty." And he said, "Well, isn't money just paper that we print? Like, why can't we just make a ton of money and just give it to everyone so no one's poor?" And of course,
yeah,
trying to have sort of a high level economic discussion with an elementary, primary elementary student where, well, then the value goes down and you got too much in the system and it's not worth what it used to be and all of that. But like, that's really what this is. The more that we're throwing into the system, and it's just basic teach to a second grader, it's going to increase it unless, to your point, there's some other mechanism to cover this. I mean, my kids would also like to have a Slurpee every single day because in the moment it's great. Like that doesn't mean it's good for them over the next, 5 years of their life.
yeah.
And that's what this relates to. I mean, this feels truly like a let me pacify everyone right now, and long-term implications, who cares?
Right. And it's popular. So the number one job of a politician is to try to stay popular and
Sure.
get reelected. But if they're being honest, the two biggest causes of inflation historically throughout all of time have been too much government spending. And as a nation, still running a deficit above $2 trillion. Dollars. New York runs a massive deficit each and every year. So there's not like there's this big pile of money sitting around to send out to people. I'm for all for sending people their money back. New Yorkers pay a lot of taxes. If there was
Sure.
this big pot of gold sitting there, by all means, but that's not what they're suggesting. They're suggesting we have this huge deficit. Let's make it even bigger. Let's borrow $3 billion and send it out to people because the price of eggs are too high. And unfortunately, that's not going to cause the price of eggs to go down. If anything, it'll cause them to go up even more.
Yeah.
And then we have the money supply. And this is not,
Mhm.
New York's fault or any state's fault. This is the Federal Reserve, the federal government. And what we saw in 2020 and 2021 was simply unprecedented and irresponsible. Just an enormous 40% increase in the money supply in 2 years. And then they woke up and said, "Oh, we can't keep doing this." And that was good, John. They pulled it back. You could see it went negative. That's why the inflation rate came down from 9% to 2.4%. And the reason why I would suggest it's going back up now is we're increasing the deficit and the money supply. You can see here, it's slowly creeping up again. We do not want to see a repeat of 2020, 21. I don't think we will. But the big question for next year, John, are we going to be able to tackle this? Is there going to be bipartisan support or support for some of the suggestions that are going to be made by Elon Musk and Doge? Are they going to actually tackle some of this, make those hard decisions? Because as you know, once you give someone something, you start taking it away, it's going to be difficult.
Yep.
But beyond that, there seems to be a lot of waste, a lot of fraud, abuse, and you have comments from Bernie Sanders reaching out across the aisle, which I think is a good sign, saying, let's work together with Elon Musk. Let's cut, he's talking about defense spending, but every area probably has waste and just inefficiencies that could be cut. Are you hopeful at all that we're going to at least attempt to tackle this for
Well,
2025?
absolutely. I mean, I think a lot of the biggest line items are going to need to stay in place because they're the entitlement benefit. Entitlements is a word that I don't like to use because people did pay into Social Security, but
Yeah.
those sorts of benefits that are really important. A lot of the social benefits. So I think there's only so much we can do, but it doesn't mean we shouldn't go through it and see what's wasteful and what doesn't need to be there. And I'm hopeful and cautiously optimistic that we'll be able to get something done there. I think the other point to your money supply on the next slide, you were showing that money supply side.
Yeah.
Yeah, I mean, and that's why in 2022 we saw the worst stock bond balance portfolio performance in 50 years, right? And so I think we have to be okay with a lot of these different tough decisions even as a society or as investors to go, there might be some short-term pain. This is going to be better, not just for our country, but potentially even for me as an investor over the next 25 years.
You got to really take a long-term view, right? In order
But that's really hard because we're humans.
Yeah.
And so we're fixated on the now.
Yeah, because we have GDP growth at 3%. And if we do this massive cut, part of that, sizable part of that has come from that deficit and government spending. And if you pull back, you're going to see growth go down. You're going to see businesses that have been benefiting from that spending make less in profits. And that's a trade-off for in the long run so that our kids and our grandkids aren't saddled with this debt and we don't have a debt crisis on our hands.
Bingo. I mean, if you love your lifestyle, but you're funding a lot of it with a credit card, and 1 month you decide, this isn't really good. We've got this high interest credit card. I'm going to cut up my credit card. I'm going Dave Ramsey.
Yeah.
It's not as fun the next month when you can't pay for your massage at the Four Seasons because you've decided you're not going to do that. There is some pain that has to go through, but you'd hope that leads you to a better place long term.
100%. Okay, let's go to number 4 here. Nasdaq 20,000. I'm showing you the milestones here. Each 1,000 point milestone. We hit 20,000 this week for the first time. And what's interesting here, John, is it took 4.5 years for the Nasdaq to double. It hit 10,000 in June 2020. But if you go before that, what was the period it took to double, to go from 5 to 10? It was actually over 20 years. We hit 5,000 in March 2000, right around the peak of the tech bubble, and it took over 20 years. So it's not a straight line. It's not a consistent thing in terms of the stock market and returns and performance. And you can have long periods of time. We had 15 years, I'm showing you here in this chart, where the Nasdaq didn't hit an all-time high from 2000 to 2015. What do you make of the Nasdaq's run the past 4.5 years, and what would you be cautioning or saying to investors about the returns in the past decade from Nasdaq and tech stocks?
Yeah, I mean, I think it's an evergreen lesson that I have been saying, daily to investors that I meet with, which is it's, reason number 6,221 why timing the market is hard and why the risk of being out of the market is greater than the risk of being in, because it's very common that returns come rapidly. Bear markets and crashes come rapidly, and people sort of know that intuitively, like, oh, there's a 14% correction, in the S&P year to year, but the recoveries and the growth also happen often very quickly. So you need to have a portfolio that you can live with and one that you're comfortable with, whatever that mix is, because a lot of times the returns come in very short bursts, and if you're not there invested when they happen, you can miss out on them very easily, as you've seen here with the Nasdaq.
Great point. And let's transition. Speaking of Nasdaq, top company in the Nasdaq, Apple, biggest company in the world. Its market cap, I think it hit 3.7 trillion this week. I think I have a chart on that. We'll show that. But what I want to highlight here and get your take on here is the price to sales ratio. So simply, what are investors paying for a level of sales for Apple over the last year? You can see here now it's 9.7 times sales. That's the highest in history. Historical average around 2.8. And it's kind of remarkable that Apple's valuation is at a record high because its growth rate is not at a record high. It's actually grown its sales around 6% over the past year, which obviously for many years it was growing much faster than that. But when you look at a chart like this, and here I'm showing you other valuation levels for Apple, and this is the largest stock in the world. It's most investors who are watching this, myself and probably yourself included, it's your largest holding if you're a broadly diversified investor, simply because that's the largest holding in the index that you own. And if we look at their PE ratio, their EV to EBITDA ratio, we look at price to sales ratio, we look at this, and then we're armed with the fact that Warren Buffett, the greatest value investor of all time, well, guess what? He sold this year 70% of his Apple stake. What does that raise any issues for you? What should an investor take away from that, and should they be concerned at all by elevated valuations in some of the biggest companies in the index?
I think they should be concerned if they're not well diversified. Anytime you're going to concentrate and take big bets in any individual stock, even one with as big a, as solid of a moat as Apple has around it, you're taking the risk of anything can happen to one single company, right? And even if you look at Apple's history, I mean, you bought it back in '83 and you've held it this whole time on like $100,000, you're 80 million or whatever it is today. I mean, it's been remarkable, but that was accompanied by a series of drawdowns over 50%, multiple.
Yep.
Without any knowledge that Apple would, become this dominant and be the biggest company in the world. So whenever you're buying an individual stock, the challenge is not only trying to deal with these sorts of valuations and making sense of them, but also investor sentiment and when would be the right time to sell, which is often harder. You mentioned that Buffett just sold. Buffett's performance has been basically the same as the S&P the last 25 years. I mean, so I think that's kind of funny. We treat him as this, and he's been great. And I'm not taking, he's a brilliant guy. I'm not taking anything away from Warren Buffett, obviously, but the idea that what he does should signal something for investors. And I know a lot of people that do this. Buffett just did this. I heard this other billionaire tweet this. I read it. I'm going to do, it's like, Warren Buffett has basically gotten you the same returns. If he came and knocked on your door, Charlie, 25 years ago, it's like, I'll personally invest all of your money, Charlie. Of course, everyone would say, this is amazing. I just basically hit the lottery because Warren Buffett's going to handle my money. Yeah. You'd have done just as well buying a Vanguard S&P index fund, losing your login and never looking at it, never spending 1 second.
I posted that chart. What people write back to me, well, what about 30 years? The 30-year chart does look better for Berkshire. Yeah.
And of course you can move the goalposts. And again, it's not to diminish anything against him. It's just to say this is really hard, even for the people with the most access to information, the smartest, people. It's very, very difficult. And that's why you mentioned it just a moment ago. If you broadly diversify and you own indexes, you're going to participate in the growth. You already have been participating in this growth. You've gotten remarkable returns in 2023 and 2024 without ever needing to worry about these things. Now, it can be fun to think about them. It can be entertaining. You might win over short periods of time, but good luck trying to do that over 30 or 40 years. My advice, broadly diversify and rebalance.
Yeah, Warren Buffett's objective is different than yours or my own, and he has a very, very long time frame, and he could be very patient and waiting, and he has experience of doing this, John, which most people have difficulty doing during panics, during crashes, during recessions. That's when he likes to be most aggressive. Most people don't have the temperament for that. But when Buffett and Berkshire started buying Apple, it was 10 times earnings at a P ratio of 10. It might seem hard to believe. It was in the value indices. This was back in 2016. You could see it here on the chart. He's talking about 10. Now it's 40 times. So I could not, if he wasn't selling Apple here, I would have to say, what are they doing? Because that kind of goes against their value orientation here. And he probably never thought in a million years that they would get the return on Apple. It's over 10x since he purchased it. And to just have this kind of gift here where you can sell it at 40 times earnings is kind of probably
and you know what else, Charlie? I mean, if you mentioned it, and I think it's really important to not miss. Warren Buffett's in his 90s, and he's one of the richest people in the world.
Yeah.
If you're Mr. and Mrs. Smith and you've got $1 million saved for retirement, and that's everything you're depending upon, and you've got a big position in Apple, that's going to be very difficult to act rationally. Even if you're right, good luck acting appropriately on that. He has the ability to separate the price of Apple from his life and its impact on his life a lot more than the average investor can.
100%. 100%. Apple could go down 80, 90% and nothing would change, right? For Warren Buffett. That's not true for the average person. But I want to show you this chart here. 5 largest companies in the world: Apple, Nvidia, Microsoft, Amazon, and Google. I'm never going to call it Alphabet. I always have to call it Google because it's just a ridiculous thing that they did changing it. But here's the question here, John. It's a fun one I posted on X, getting a poll. I don't have the final results here. We got 9 hours left, but which company's products, and I'm just picking these 4. I'm leaving NVIDIA out because I don't think most people, are tied to that on their day-to-day lives. Which company's products would be the hardest for you to live without? Amazon, Apple, Google, or Microsoft? So simply the products they have today, let's say that tomorrow that didn't exist, what would be the most difficult for you?
This is so easy
personally.
For me.
Let's separate it personally,
okay,
and then professionally.
Okay, so personally, this is incredibly easy. I got an AirPod in my ear, and we all have iPhones, and our kids have iPads. So you would think it would be Apple. Absolutely not. I don't know what we would do without Amazon. No idea what we do without Amazon. That's what we utilize. And my thinking is I could get used to using, an Android. Now, I know everyone listening that's like an Apple believer is like, that's heresy, John. How could you possibly say that? But I think like with Google, you could find replacements. With Apple, you would just transition over to like a Droid phone and non-Apple products for tablets and stuff like that, right? I think you could find the replacements. What are you doing if you don't have Amazon? There's no way. So personally, absolutely, it would be, I couldn't give up Amazon for my day-to-day life. That would impact our family a lot more than anything else.
And specifically, are you referring to just Prime and the ability to get things when you need it on point?
Yeah, it's not my Kindle. It's not my Kindle. Yeah,
it's not your Kindle. It's not Amazon. It's not the Prime Video. It's not Alexa.
It's buying 90% of everything we need to buy by going to my phone and going, oh, I need a nail kit to pound in the uplights for my 30-foot Santa blow up that's in my front yard. Like I would have to go to a store. Like I'd have to walk around Home Depot.
So I'm 100%. I had the same. So I'm with you on the personal, but it's interesting that you see Amazon, right, at least now is the lowest.
Right.
So what about professionally? Does that answer change?
Totally, because how often do you don't feel like you need Amazon purchases for your business, right? So at that point, you're probably going to gravitate here, which is why probably Apple and Microsoft are both high. Depends, like, is your business operating on Apple products or more PC, right? It's probably going to be one of those. I don't really understand the Google one. Help me understand that, because you might use Google, but like, what is it, your Gmail people are worried about or something?
I think it's Gmail. I think it's search. It's probably YouTube.
YouTube. Yeah, YouTube. Yep.
I guess if they have a Google phone, but YouTube, you could find it on Spotify. Like, do you need it? I mean, YouTube's
well,
great.
shoot, you just reminded me of YouTube TV with NFL Sunday Ticket. Dang, now I might have to change my answer. I didn't think about all the things Google owns. Yeah,
that's right. Look, they've become but for me, I'm just like I'm so used to Excel. I don't think just transitioning to Google Sheets, I could do it, but that would be a tough one to give up. But
you know what I think the lesson in all of this is, Charlie?
Yeah.
All 4 of these companies, like to your point, and then you throw NVIDIA in on like the peripheral of all the different ways that impacts our lives indirectly.
Yeah.
It'd be really hard to live without any of these, which is why their valuations are what they are. And there's such high concentration at the top of the index.
Correct. Like what I always say is there's like before NVIDIA jumped on board, like it made sense to anyone looking at that index that these were the 4 largest companies. Like, and that's what makes it so hard as we transition here to the next segment here. That's what makes it so hard to believe that this exceptional valuation that America has versus its peers will ever not be there, because we use these products of these 4 companies every single day. And so I want to just run through a few charts and get your take here. This is the ratio of the S&P 500 to MSCI World ex-US. So basically just taking out the US, all international stocks. And you can see here, we're more than 3 standard deviations above the mean of this ratio. Simply means we've never been in this territory before. U.S. has been outperforming international stocks for 16 years running. There's nothing even close historically, right? Historically, you'd have swings back and forth. You'd have some outperformance, then underperformance. Now we're going on 16 years, and it's not just a small amount, right? It's an enormous amount. And what that's led to, John, is these next 2 charts here I'm showing you, S&P versus MSCI World valuation. So it's not just that the U.S. fundamentals were better over the last 16 years. They definitely have been, right? So U.S. earnings growth much better than international. So part of it is fundamentals, but the other part is that sentiment and expectations for the U.S. have grown as well. And what I'm showing you here is forward price to earnings ratio for the S&P is about 22 times, and for international stocks, it's around 14 times. And that differential, 22-14, we've never seen it that big. And I'm going to show you a CAPE ratio that shows something similar, looking at U.S. versus Europe, because a lot of people will say, well, international, is that some emerging market that deserves a lower valuation? So let's just go U.S. versus Europe here. 37.7 on the CAPE for the U.S., 20.3 for Europe. It's an 86% now premium between the two. Highest, as you can see here by the chart, highest in history. And it would probably surprise people to know that back in the 80s, European stocks actually traded at a premium to U.S. stocks. Wow. But what do you make of all this? I know when you speak to clients and they look at their portfolios, the number one thing they're going to point to with any diversified portfolio is what isn't performing as well, right? That's by its nature.
Sure.
How do you use these kind of visuals to say, well, maybe we won't always see this, maybe it's gone up too much, or how do you think about this?
Well, I mean, an analogy that I think the average Main Street investor can understand is certainly you'd rather sit on the 50-yard line, of your favorite NFL team's game on, 10 rows up, but those seats cost more than the nosebleeds, right? I mean, there's no debate now that the better companies and are here in America, and the technology companies, certainly. The question is just what you showed. Well, is the difference in valuation like equalizing that? Or at some point, does it make sense to go rotate back more into international? Not because you think that some random manufacturing company in Great Britain is going to do better than Nvidia or Apple, right? It's that you wonder if it's cheap enough now to justify to potentially get better growth moving forward because the starting price is so much lower. And I think this, I mean, it's boring. It's people watching it YouTube video are like, wait, you're going to tell me again to diversify? Like, can you give me something sexy that's actually interesting? But that is why it's difficult. I mean, the lost decade wasn't that long ago, right? I mean, these things do rotate. Yeah. Oh, you had it on there. Yeah. So it's like they do rotate. And so I think it's very reasonable to say I have a lot of belief in the future of America. I love these companies, but they also are pretty expensive right now. And so I'm not going to go 100% all in on US stocks. And it's not even as much of a growth play. Anytime you're diversifying, you're acknowledging a level of humility to say, I don't know what's going to happen. And because I don't know what's going to happen, certainly for people whose plan is already going to quote unquote work, like the retiree who has $3 million saved and says, I want $100K a year to supplement, my Social Security and a pension I have and some rental income. Like they also need to be thinking about managing risk to say, all right, if that tail risk scenario occurs at one time between 60 and 90 years old, how do I insulate myself? Like, how do I protect myself? And that might come with, the hindsight bias 20 years down the road of going, dang it, I could have made more money if I just stayed all in US. But you would hopefully follow that up with a reminder of, yeah, but I didn't know that 20 years ago. And I wanted to make sure that I always had enough money to do every single thing that I possibly can with my, without worrying about this. And so I think it's a managing risk thing more than anything else. Yeah. And it wouldn't be crazy if international, or small value or something else rotated in and was the highest performer over the next 5 years, not because those companies were better, but because they were cheaper.
Yeah. So the way I look at it, John, let me know if this makes any sense, because this is what I've been saying. You don't have to believe that this is going to converge to justify owning outside the US.
Exactly.
You just have to believe that a further widening in this gap, given where it is right now, is unlikely. Right? Yep. So let's say the valuations stay where they are, right? And it's just is what it is over the next 10 years. They're better companies. They have better margins, so they deserve higher valuations. There's some people making that argument. That's fine, right? But that extra outperformance that you've gotten in the past decade plus from this widening gap, well, that's not going to continue unless you think this multiple spread is likely to increase. It could, but I wouldn't be betting, as you pointed out, your entire life savings on that. And just how would you feel if we had a 10-year period where large cap growth stocks were down 33% and you were entirely concentrated there, that would probably be a very difficult conversation 10 years from now with yourself saying, well, I could have diversified. I had this evidence to suggest that there were other periods where this happened. I saw that this valuation spreads is at a record level and sentiment is where it is. Maybe I should have thought about it. And you, unfortunately, John, you can't diversify after the fact. You have to do it before, and doing it when it's most painful historically has been a good thing. I know I've been saying this now for a few years.
So true, though.
But you have to do it when it's painful, because that's when it's going to pay off most for you, is when you're getting this type of differential where you're buying other areas that are not performing as well when they're cheaper.
Well, and I think defining the expectation and your objectives, if your objective is to get the most quality and what I would say the best word for it is durable returns over the next, let's say, rest of your life, just over the rest of my life, how do I get the most durable returns?
Yep.
Well, then you're going to invest differently than saying, what's done the best the last 3 years? Oh no, I've missed on that. You're reminding yourself, my goal is to achieve returns that are in excess of what I need to accomplish all the goals that are important to me. And reminding yourself that all along the way, my ultimate goal is to never have this thing blow up. And a lot of crazy stuff happens over 50 years as an investor or 60 years as an investor. So reminding yourself, I'm building this so that at no point during those 60 years do I look back and go, yep, dang, that one time over 6 decades, I made a really big mistake. Because as you know, Charlie, that one mistake, even at 59 years, you're phenomenal. You're the best stock picker in the world for 59 years. And in one of the years, you put everything in Enron and Washington Mutual and AOL. It doesn't matter that you were exceptional the other 59 years. It's over. You blew it up. And so you're trying to provide yourself with durable returns.
Yeah. And the real fascinating thing about this is, like, it's only from a U.S. investor's perspective that this diversification has been costly.
Sure.
Right? Everywhere else in the world, if you had home bias and you were investing more in your home country in the last 10, 15 years, well, that has killed you, right? Because you didn't invest in the U.S. at the weight, the market weight, right? So it's just it's just funny because we're only looking at it from the U.S. perspective, but everywhere else in the world, someone's having this conversation with their clients.
You really need to get in the U.S. You need to invest a little more in the U.S. You know, get out all these Euro stocks.
All right, so let's go to the last segment here. We end with something positive, and there's a lot of positive things going on, but number one would be real wages, and number two, interesting, we got data points this week that small business optimism is spiking higher. So first, average hourly earnings. This to me is the most important chart in markets for an economy. When this is going up, when this is above zero, it's good news for everyone because it means your wages are outpacing inflation. For 25 straight months, it was not happy news that I was delivering because people's wages were not keeping pace with inflation. But thankfully, the last 19 months, it may not feel like it, but at least if you believe the reported data, and if you don't, that's a different discussion. But if you believe the reported data, the increases in your wages are likely outpacing inflation for the last 19 months. And what that means for the economy. So when I look at this, John, it's not surprising to me that we're still seeing economic growth. We're still seeing people spend money on vacations and other things. If you look at Walmart, I just pulled this up right before because I've just been seeing it hit record high after record high. It's up 83% this year. I got to go back and look, but I would venture to guess that Walmart's never had a return in any year. This is highly, highly unusual. Obviously, Walmart being the number one retailer in America, and they're doing pretty well because people are doing pretty well. They still have their jobs. They're making more than they did a year ago, and wages are above inflation. Is this the general thing you're hearing from people, despite, I know, all of the complaints, and I have the same complaints
not at all.
In terms of the cumulative inflation, but that at least things seem to be moving in the right direction?
Yeah, I mean, that's a really interesting, just to look at that stock might be the most indicative, story, answer to the question of how are consumers doing? Like,
Yeah.
how's the average American doing, right? I mean, it doesn't tell the whole story, but
No.
that's a pretty good data point. No, I'm hearing the exact opposite, Charlie, because we like to complain. I think as we have a bias toward negativity. The media is always negative. Everybody else clicked off of this. They're already done watching this because they're like, wait, the last thing Charlie's talking about is positive.
Yeah.
Boom, I'm done. That's not interesting. But no, in all seriousness, people don't see this because every single time you go to buy something, which is like throughout every day,
Yeah.
you're confronted with the higher prices.
Yeah.
When you get a raise, it auto deposits into your account. You throw some into your 401k. Some of it goes out for taxes. You know, you were saying people don't necessarily believe this. They don't. I would encourage people, look at their specific situation. Forget what's happened across the country. Just say, what was I making 3 years ago, 4 years ago? Like, what was my salary? What do I make now? And just look at it. How much higher actually is it, than it was before? And I think for most people, of course, I'm painting with a broad brush. Some people might do that exercise and go, dang,
Yeah.
I need to look for a different employer because everybody else seems to be making more money and I'm not, right?
Yeah.
And this is unemployment's really low. This is a really good opportunity to make a shift career-wise if you're able to, if you're not seeing that growth. But I think for a lot of people, they'd go, yeah, it's not really front and center. I don't really notice it, but I am doing better. And I think the other reason is because the prices, the purchases we're making are one after another, one after another.
Sure.
We absorb that raise. We get some lifestyle creep. It doesn't feel like we have this massive margin.
Yeah.
Right? And from a financial planning perspective, one of the things that I tell people, every time you get a raise, take half of it and add it to your savings, and hopefully you're giving, if you're giving some money, and then just enjoy the other half. So essentially pretend always on your raises, you're getting half of what you actually got. You get a $10,000 raise, pretend it's 5,000. Don't even act like you got 10,000 because you'll just absorb all of it. And we do. That's just what we do if you're not being intentional. So automate extra savings and giving to give yourself some of that margin, but still enjoying, the fruits of your reward.
Yeah. Awesome. Okay. So we got one more thing here. Small business optimism. I don't usually talk about this index, but it's been languishing for a few years. We got this huge spike higher after the election. There's a lot of optimism about deregulation. We got more certainty in terms of the tax policy, that the Tax Cuts and Jobs Act that was passed back in 2017, they're going to keep those changes, and that seems to be, based on this survey, a relief to a lot of people. So a big spike higher in the last month in small business optimism. Have you talked to any business owners? What do you make of? Obviously, we think there's going to be certainly deregulation on the tax side. It's unlikely we're going to see higher taxes, or we're going to see lower taxes, maybe not, but it seems like the permanence of the tax cuts from a few years ago, keeping that was a relief to a lot of small business owners.
I think that's the number one thing. But even more so than the deregulation, small business owners are seeing it as a positive that taxes are less likely when they sunset at the end of 2025 that they're scheduled to now to jump up. I think that was the biggest thing. And there had been some proposals prior to the election of potentially even corporate rates going a little bit higher and things.
Yes.
I think the fact that appears to be probably done for now, of course, we don't know for sure.
Right.
I think that's the overwhelming majority of this sentiment increase.
Awesome. Okay, so we'll see how this reflects. So this is sentiment. Will it translate into more activity, hiring, growth?
Sure.
Hopefully it will, but we'll have to revisit this and see if it will. But that's a great place to end. John, awesome having you on the show. Always awesome. For everyone watching this, check John out. He has joined X, but I don't believe he's posted yet. So I'm going to try to get him
Charlie,
to
you
start
talked me
posting on
into
there.
it. You talked me
I'm
into
going
it.
to tag him when I post this video. But 2025 is going to be a big year for John on X. Definitely check him out on the Rethink Your Money podcast. Thanks, everyone, for joining us. Have an awesome weekend, and I'll see you next time on the Week in Charts.